give this a second to turn on. It looks like it's trying. Deal with that. All right, we're live. All right, what's up, everybody? So the video today, as you could tell, is super impromptu. Had really no plans to do this via a live stream, but this is a common piece of feedback / request that I've gotten from people, which is if I can try to like show a little bit of the back end process of stuff a little bit more. So I thought what I would do here is literally take you for a walk through the back end process of the strategy that we're about to talk about today, which is a leveraged covered strangle in something like SSO, TQQQs, both of them, whatever we decide. All of it's really up for conversation right now. None of this is defined. So what's this whole thing about? A couple things. I truly believe one of the best ways to dip your toes into trading, rather than trying to target a arbitrary return percentage that you think you want, I think it makes a lot of sense to try and pace, then slightly beat the S&P 500. I think it's a great starting point. And that slows a lot of people down because a lot of us approach this problem set from what is it that I want to return, completely foregoing the fact that the market doesn't care at all what you want to return. It doesn't care. It literally doesn't matter. What matters is what your skill set is and what you're capable of doing. So the idea behind this is to start with that problem set. So what I'm going to do is first lay the foundation for this entire concept, and to start with a very visual tool that's easier, I think, for people to kind of synthesize. We will start by taking a look at Portfolio Visualizer. So here, we're going to go to a back test of portfolio, and then we're going to eyeball it, right? We're going to see if this idea has any merit whatsoever to start with. So what we're going to do is we're going to drop something like SSO. Then we'll drop, we can only do 3 portfolios. So let's do SSO, let's do UPRO, and then actually, no, let's do SSO, let's do QLD, and then let's do TQQQs. And then it's automatically going to compare it against the S&P 500 up top. So now what I'm going to do is get a sense of the performance. Now, before I click this button, I can already tell you what I'm going to see. I know what the yield is here. I've done this tons of times. If you are new to this kind of thing, and this isn't the way that you think about building a strategy, building approach, whatever, highest recommendation is before I click this button, think about what you're going to see. The reason why I think that this is massively important is because I am trying to train your brain to be perceptive, to not wait for an answer to show up. These are socks, by the way. This is the answer in this scenario. Don't know why, just happen to have them in my left hand. So here's your answer. Rather than waiting and seeing what the answer is that's just given to you, try and read between the lines on what you expect to see. So some of the things to consider here are stuff like, okay, we know that I think this goes back maximum of 10 years. I know it has it 85 to 2024. I have the free version. So I think this goes back just 10 years. So reference this for the past 10 years, what's happened and what you expect these results to look like. That's step A. So now let's analyze the portfolios and see what they look like. Yeah, okay, so it takes us back to January 2015. Right here. So it's limited to 10 years for free tier accounts. Totally cool. And let's see. So we have the S&P 500. That's the last column here. We can see what the return was in the S&P 500 over this 10-year period. And this is taking $10,000. The starting amount literally doesn't matter. This is just picking a random amount of money. So, which in this case is just the default. So we can see that TQQQs has clearly performed the best. We can see that QLD is second best. And then we can see that SSO is marginally better than SPY, not by much. So if we look at the actual compound annual growth rates, really important metric, this tells us, including return volatility, what does our money growth rate look like on an annualized return basis? The higher the number here, the better. Then we have standard deviation. Typically, the lower the number here, the better. The reason is because what this is telling you is that you can have a massive deviation off of your returns. So that becomes a really important planning factor. So one of the first things we have to keep in mind now, we're talking about this idea of using leveraged ETFs to trade the covered strangle. And if you're unfamiliar with the covered strangle, I'll drop a video for you in the here. That's a video about the covered strangle. But essentially, it's the process of selling cash secure puts, holding long shares, selling calls at a ratio to the long deltas. That's it in a nutshell. Lots of different versions available, lots of different ways to think about it, but that's pretty much what it is. So why am I bringing that up? Because if I'm holding shares of something, this sucks. Really big standard deviation of returns sucks. So that comes into my mind as I'm just very loosely starting to piece together this idea in my brain. So what's the first part of this idea of covered strangle, levered ETF? It's that levered ETFs in the long run can and do outperform benchmarks. Okay, how do they do that? It's by taking increased beta. Beta is movement, and it's a directional risk measure. So if you're holding SPY, your beta is 1. If you're holding something like TQQQs, we'll take a look in the platform what the current beta is. It's going to be more than 1. So the way that you make money by stripping away the covered strangle element to this and talking about it purely in terms of buy and hold comparison, the reason why this outperforms this is because of beta. The beta is achieved through leverage. That leverage increases return volatility. That's the relationship here. So with all of that context, we should start thinking about how can we try and maximize the benefit of this and minimize the drawdown element, because if we scroll down here to the worst year, the drawdown is absolutely massive. And the drawdown in this circumstance is much better than what it could have been. Because if you go back into the 90s, 2000s, early periods, there are huge drawdowns that could almost lead to insolvency. So that's something that has to be considered. So for me, in my brain, that knowing that even in a not really bad bear market over the last 10 years, we did not have a bad bear market over the last 10 years. If I take a look at returns, let's take a look going back, and let's go back to when the reference here is 2015. The worst year was negative 19.4%. That's not the worst drawdown, which is what this is tracking, to be clear. I'm just oh no, it is. Yeah, this is talking maximum draw. Whoa, that's kind of weird. The fact that those are the same is weird. I'm sus. That doesn't sound right. Anyways, the worst year from 2015, the reference period to now, was 2022, which was down 19.5% or so. That's the worst. So this tells me this had a really, really adverse move, even though the market has had pretty big drawdowns in this period, but nothing massive, which again, we're going to look at a data set. We're going to quantify all of this. Right now, this is just the fitting process. This is eyeballing shit. This is getting contextual information to build into the background. This gives me ideas and inspirations for elements that I need to look at, literally like what I just said, right? So this is saying that the worst year and the maximum drawdown are the same. I don't believe that to be true. It could be, but I'm just suspect on that. So what this tells me is I need to test this, not just for the past 10 years. I'm going to get a bigger data set and do it, but definitely I need to look at this and see what the worst drawdown was, because I'm guessing if the worst year was this, then it's probably higher, or they're just pegging the worst year off of this. I honestly don't understand, because this one's different. And so is this one. But I don't understand why these are different. Doesn't make sense to me. That's okay. So this is the context. We want to beat the market. It can be difficult to beat the market in the beginning. There are pros and cons to something like this. One of the best common things we can see, one of the best elements we can see in something like this specifically, is how does this fit into the portfolio? And that is absolutely something that has to happen, because I have to be completely honest with you. If I was trying to grow a portfolio, this is not what I would do at all. By and large, not even close. But I also know for a lot of people, something like this is really appealing because it can be a low effort element of a broader plan that we can amplify a bit with options, which is cool. So let's take a look at some of these other metrics really quick. I am most interested in not this, not this, not that. Not that. Nope, nope. Here we go. So this gives me a lot of context over the past 10 years on what this whole thing looks like. JRA Trades says, come on, bro, keep it Barney style like in the Marine Corps. People are going to start tuning you out into the... I got to slow down. Going to start tuning you out. Get into the strategy. Less talking. We can all see charts and verify these ETFs follow the underlying. That's awesome. Yeah. I have just one simple response, JRA Trades, on that, which is literally too fucking bad. I couldn't possibly care less if somebody tunes out. I'm not doing this for me. So if somebody doesn't have the attention span to actually synthesize information, that's on them, dog, not me. Trading a 3 times leveraged ETF is probably going to go terribly for them. That's my guess. Jerry says, what's up, dude? I've been doing the covered Strangle on TQQQ's UPRO and TNA for a while. It's working great. Just got to keep powder dry to average down and be more conservative when the market is topping. Yeah, so that's definitely something that we 100% will talk about. And that's super smart, JRA Trades. We'll get into the kind of the rules-based protocols that we can leverage. And I literally completely agree with you. I think having, I definitely think having a really thoughtful scaling approach is going to be massively important for this. However, it can't be a random approach. That's no good. All right. So this reiterates the maximum drawdowns that we saw before. And let's take a look at kurtosis. So negative skew on Qs, which is totally fine. Jerry says, I got the attention span of a crayon eater. Sorry, I didn't mean to comma as an asshole. No. I didn't take that as an asshole comment at all. I took that as you trying to look out for me, because most people will look at me on YouTube thinking that I'm trying to be like a good entertainer, but that's actually the last possible thing that I am. So no, I appreciate it. And I know that you're just doing it out of trying to take care of me. So very well received. The too fucking bad, that's for the people that have short attention spans. This just ain't going to be for them. And I say that all the time. Like, if you have a short attention span, literally trading is just not going to be for you, because so much of this requires taking the time to sit down and look at a lot of really boring shit. Like the video today is going to be really boring for the next, however long I do this, 40, 45 minutes. It's a lot of just looking at fucking data. But guess what? You can make a lot of money. That's what I care about, is making money. I've made a lot of money trading, and it's by doing a lot of boring shit like this. So that's how I look at it. All right, let's see. So annual returns, I can see, what is this? In 22, down 79. We have to look at that. So let's take a look at that just out of curiosity, because I want to I want to peek at that. And then I'm just going to move this into this because we're going to need to codify that stuff. JRA trades, just to make your life even happier. I just realized that latency is like super bad. It's set for like normal latency. I don't know why it's doing that, but sorry. The delay is probably super, super long. But JRA trades, you are going to be really happy here because guess what else is on the agenda for today? Reading 1, 2, 3, 4, 5, 6 white papers on levered ETFs. So if me talking a little bit was troublesome, just wait until we get into looking at these papers. Those people are they're gonna freeze in stone like they've looked at Medusa. That's what this is gonna be. But I'll save that charming part of this segment for a little bit. Oh, it's gonna be so good. All right, minimize this. All right, let's take a look at TQQQs. And what I want to do is I want to look at how it did in 22. Oh, shit. So it really did. Now, again, there's an error here. I can already see the error here. '30th. Yeah, boy. So if we zoom in on this, right? So if I look at the start of 22, so portfolio visualizer is 100% correct. So I can see the 1st of January of 22, it's coming in at like 85. And then it essentially just bid down the whole year. And then it hit its peak low for the year on the 30th, which is literally down here. It's like, so yeah, that looks exactly correct. The part that doesn't fully make sense to me, maybe it's just because of the rounding, but the low here was 1610. And then the last day it closed at 17.3. So maybe it's just a rounding. That's why, but they go to 2 decimals. Fuck. Now I got to check it. Because now I'm just, for anybody that watches my shit, you know that I'm always sus of data. And right now I'm sus because I want to see what the low was versus what the end of year was. So let's go to the 3rd. Okay, on the 3rd, we opened at 83.92. I'm going to drop that in my little log here, 83.92. And then the low we hit was 1610. So that's an 80.82% drawdown. Haha. Gotcha, bitch. So this is wrong. Yo, where am I? I am lost in the fucking sauce right now. Here we go. This is wrong. So the maximum drawdown actually was 80.82%. And then the worst year, I think, is this 79%. That would make sense. So there's that. Oh, damn, JRA trades. You didn't even remind me. There's another paper that I need to add to this. We need to learn about Shannon's demon. We'll get to that in a little bit. I don't know if people are ready for like a 6th or 7th paper. That's probably going to be real. That's probably going to be real problematic. But we're going to have to talk about Shannon's demon. That's a big part of what's going to go on here. JRA says, what gives me conviction about these leverage ETFs is that they've been out for a long time and have survived big drawdowns like the COVID crash. That's not the right mindset. That's not the right mindset. Because the problem with stuff like this is the biggest drawdown is still ahead. Really important to always remember that. And if you're using something like 3 times leverage, it's not optimal. 3 times leverage is not optimal. It's somewhere between 2 and 3. It's like 2.3 to 2.5, depending on a couple other metrics, 3 times leverage is not optimal. And it's because it runs the very standard risk of ruin. That's the problem. So yeah, I would not take any solace in the fact that they've been out for a little while and they haven't blown up. A lot of them have blown up actually, but like the bigger market tracking ones haven't, to your point. And it's just because we haven't really experienced anything that terrible yet. Again, like if you look at the drawdown here, right? This is an 80% drawdown from the end of 21 into the beginning of 23. If I take a look at something like this, QQQ, and we look in the same time frame, this drawdown here was significantly less. Let's see what it was. Obviously, in a percentage, I'm not like no shit Sherlock that the 3 times leverage is going to have a much bigger drawdown. But what I'm trying to highlight is the sequence of returns matters a lot, and Shannon's demon matters a lot in analyzing something like this. So if we take a look at that very same period, let's just go from the high here. The high was 408.71, 408.71. And then if we hit the low, let's just grab in here. Let's call it 260, just for ease. 260. So 36.39% drawdown. The market has had bigger drawdowns than this, right? That's the problem. JRA Trade says, yeah, I wouldn't be selling puts at the top, bro. Bro, it doesn't matter what you would do if the fund goes insolvent. That's what I'm trying to explain to you. It's not you. It doesn't matter what you do. What matters is the fund going insolvent and not being there anymore. So that's the big risk, is that they literally carry true insolvency risk, specifically in something like TQQQs, which is 3 times leverage, which we're going to have to decide what we want to trade in this model portfolio. But the game plan for me is to actually put like real money. I'm going to use real money and trade whatever we pick for the model portfolio. But like, let's say, for example, we pick TQQQ's $100,000. I literally am, when I put that $100,000 to trade this, I am going to be thinking about the insolvency risk, not of my money. I'm not so worried about my money. I can manage it. I can roll shit. I can play all sorts of games. If the fund doesn't exist anymore, you can't roll puts in it because it's fucking gone. That's the problem. So again, that's why it is so important to keep the context in mind. TQQQs experienced an 80% drawdown when the market had a peak to trough drawdown of just over 30%. The market has had much bigger drawdowns than that before. If that happens again, TQQQs literally can go insolvent. Do I think that's like super probable? No, I want to be super clear. But when we're talking about stuff like this, we have to weigh 2 different things. There's the probability of something happening, and then there's the severity. The severity in that scenario is massive. Probability, very low. Because the severity is massive, I still have to treat it with respect. That's exactly why if the severity was moderate, then yeah, moderate. JRA Trade says that's the risk of any stock, though. Here you were trading an index. It doesn't. No, man, you're not understanding. It's that there's insolvency risk for any stock. Completely agree. The difference in why the risk is more pronounced. Like, I mean, let's just look at it for an example. Let's not even debate it. I'm going to ask ChatGPT. What's the frequency of 3 times leveraged ETFs closing down? I don't want to say going insolvent because that's a very specific thing. I want to just go into closing down, closing shop, so that we can compare that to something else. The JRA, the thing that I'm trying to highlight to you is the risk is completely different. There's always insolvency risk, point granted, 100%. Trading an index here doesn't really matter. I want to see if there's any studies on it. Here you go. So this is, according to Charles Schwab, about 52% of leveraged and inverse leveraged ETFs have closed compared to a 31% closure rate for non-leveraged ETFs. There's a lot of details that I would want to go into there. I'm not going to bother. The main thing I think we can say is that it's more probable. That's all. And that's really the main point here. It's not to be, I'm not afraid of it. Literally, I just told you I'm going to put real money in whatever this thing is that's ultimately built. So I'm obviously not afraid of it. But the difference is I acknowledge it's there, right? One of the issues, JRA, from your perspective, is when you say something like, what gives you conviction is that they've been out for a while and they've handled big drawdowns, right? Like, that's not good, in my opinion. For me, what gives me conviction is that I understand how they work and I'm prepared to trade around how they work to keep me safe. I'm not resting my conviction on the longevity of the fund because, again, the worst day could be ahead of us. It's a super, super great conversation. And I'm glad you brought those points up, though, because a lot of people think of it that way. They just think, oh, like, tech's going up, TQQQs is good. And that could be for some time. Actually, that would be what I would surmise. But that's not acknowledging the risk. And if you don't acknowledge the risk, we're not going to prepare for it because we're kind of pretending it's not there. It's a bad idea. Okay. So we have some general basis now. We know a little bit about these different leverages. Now what we need to do is a couple things. The next stage I would go into is actually starting to read through some of this research. Now, this, I can already tell you, this is an undergraduate paper. I don't honestly care that much about it. I really don't. I just want to see the kind of stuff that's in here. This is the kind of paper that I would flip through super fast, spend very little time picking apart because it's just not going to weigh anything in my process too heavily. So let's see. This study examines call options, underlying indices, as well as their leverage counterparts. The barbell study strategied 88% in fixed income, 12% in call options. I actually kind of like that. Does not have higher return than the underlying index because of the volatility and adds additional risk. Yep. However, a portfolio weighted with a combination of risk-free assets and leveraged ETF does provide higher ROI, which is exactly what we'd expect, with a decreased risk as compared to the underlying index. So what they're talking about, this is, I'm actually impressed. This is good. So what they're highlighting for us here is that you can create the desired leverage for a sum of money. That's hard for people to wrap their brain around sometimes. If I have $100,000, right, whatever the portfolio is going to be, if we do 25, 50, whatever it is, I'm not doing under 25 though, because that's just super annoying. So if we have $50,000 and we put 100% of that $50,000, aka all, into TQQQs, that money essentially is going to exhibit 3 times daily leverage returns. Daily is a really important component here of understanding the product that we're trading. Okay, cool. Fun story. If instead we take the $50,000, we put $40,000 in TQQQs, then we put $10,000 in some sort of risk-free asset, the $40,000 that is in TQQQs will still have that ever so very the same 3 times daily leverage. But that $50,000 in total will now have a different aggregate leverage assigned to it that is not 3 times daily leveraged because 10% of it is parked in a risk-free asset of some sort. So you can modulate not the volatility of the product that you're trading, in this case TQQQs, but you can moderate the total amount of leverage of a sum of money. So that's what this is talking about, and it's a good idea. I'm not going to do it, by the way, but it's a good idea. The reason why I'm not going to do it is because I don't care. Like it's going to be slow and boring. I'm not trying to build a slow and boring thing here. I'm trying to build something that's a little bit more aggressive than that. Again, this is like a side display project that I want to work on with you. This is not what I would do to build a portfolio. I want to be super clear about that. Okay, here we go. We can skip all this madness because I've probably read most of the stuff that they're looking at. Yep, okay, here you go. In case you need to learn about calls and puts, it's a nice table. It's a good visual here. All right, let's check out the methodology. Explores various investing strategies, risk-free and risky assets. I like that combination, IEF and leverage ETFs. Okay, IEF is fine. Okay, so it's using 1 times, 2 times, 3 times. 1 times, 2 times, 3 times. Okay, I like that. So that'll give a decent breakdown. Bonds are proxied by IEF, okay? And they're using calls. So the thing to remember is that if you're using calls on UPRO, calls are leveraged. UPRO is leveraged. So you are talking about a leverage position. You would actually literally have to calculate the leverage. I don't know what it is off the top of my head. It would depend on the deltas of the calls. But this is not too similar to what we're talking about, which again, right now I'm thinking about the covered strangle, but by the end of this, that could change. Because my goal is by the end of this video, after going through this with you, I literally want us to decide, or at least lay out the decision points we need to make to decide for the next video on what the portfolio is going to be. Because then we have to go through a bunch of research on that, going back, testing the allocations and stuff. So this right now is gaining understanding and context. That's the point. Greater or lesser allocation for call options could be substituted without difficulty to track with actual investor risk profiles, okay? Increasing the percentage of options, increasing the possibility of loss. Yes, of course. A balance must be struck. Yes. While some in the industry suggest 85-15 and 90-10, we chose the 88-12. Okay, we're getting real specific here, gotta say. However, individual investors could apply different percentage. Okay, let's see. Where's the data from? They probably wouldn't have went across that in the methodology. I probably just didn't see it. Yeah, okay. NASDAQ from 07-10. Refine the comparison period. So they're looking from 2010 to 21. That's super important. That date is very, very important, because the reason why that matters is because if you started this right before we go into, the global financial crisis, the outputs of this entire study are entirely different. So if we take a look at a chart really quick of 2010, just to show this point, put this down here. So if we go back, max, and we go to 2010, right? You can see that by starting in August towards the end of the year of 2010, you're starting actually at a really advantageous point. I'm not saying that they cherry picked it. I'm sure there were different reasons based on the study that we didn't get to yet. But again, just from a baseline perspective, these are the details that you have to pick out. This is why if you have limited attention span, this shit's not for you, because you have to read between the lines on some of this stuff as you're trying to gain as much information from these different sources. So in this case, I can tell you that by starting during this period, that puts the overall output of the study at an advantageous period because it's post GFC, which again, not saying is bad. You just need to know that that's happening. That's all. Okay, that point's been made. Joey says, does this mean liquidity is also showing a wider spread on leverage ETFs because of inherent volatility? Yeah, definitely. So the reason why you'll see as a percentage of the basis, volatility absolutely matters. But the other thing that is going to matter the most is literally just how much it's traded, right? Because a lot of the people that are trading leveraged ETFs, they're going to gravitate to more leverage. You have to think of the people that are going to trade these things, because trading something like this for, again, trying to aggressively grow the account or something like that, and you have a high risk tolerance, you're going to do that here in TQQQs. That's exactly what's going to happen. If you have a high risk tolerance, it's going to be done here. But my recommendation for the portfolio I'm going to make for myself, and again, we're going to talk about it, is that if we pick TQQQs, I would use a smaller amount of money. So let's say that we started wanting to do $250,000, $250,000 in this leveraged ETF experiment. Well, if we arrive that we want to really hone in on TQQQs, I would pare that way down, because I wouldn't put 250,000 of my dollars into some TQQQ strategy. That's like, again, like I have skin in this game. So I'm not going to make a completely stupid decision. And I'm not saying it's completely stupid, but there's just, I can make money way more efficiently with that $250,000 than this. So there is that, again, there's a balance from the actual application of how I'm analyzing this shit, because this is not purely in a theoretical sense. Like, I'm going to put money and do this. So part of the question I ask myself as I look at this stuff is, how much of my personal capital am I willing to fuck around and find out with this experiment? And I already know the weighting will be different depending on what we land on. Again, I'm not picking the number myself. I want to pick the number with you all, because the other thing is I want the number to be applicable. So like, for example, if we were going to do Qs and QLD and I was going to do $250,000 on that, if that sum of money is not even remotely relatable to the people that are going to follow along with this, then I don't want to do that, right? It doesn't matter. Now, I also want to be really clear. I don't want to set this up so people just copy what I do. That's the last possible fucking thing that I'm trying to achieve by this, because everybody's got to do what's right for them. I'm trying to show literally a live experiment. That's the goal behind this. So with all that context, depending on where we land and depending on what amount of money we choose, it's going to change based on these different things. And it's literally for the reasons that we're talking about now. All right. All the statistics, indices, yeah. So it came from CRISP. For those that don't know, CRISP is like the gold standard for studies on this stuff. So CRISP is super expensive. I don't use data from them because it's literally built for like colleges and like straight up stuff like this. But CRISP is good, and they have pretty like robust data sets. If you read through, again, as we poke through the rest of these studies, I literally guarantee you're going to see that name again, because it's what everybody uses. All right, so they obtain option prices from delta neutral information. Assumption is that options are purchased at the ask and sold at the bid. That's great. I love that. So I'm actually really impressed, because for an undergrad, thinking of it this way, like this is accounting for the bid-ask spread. They're not giving themselves even the favor of saying, I assume we transact at the midpoint, which would also be very reasonable, to be completely honest, because this is drastically going to hurt less liquid stuff like SSO and QLD. Again, attention, reading into these small details, they matter because it informs me different outcomes that I can expect. If you read through this stuff, if you go through this process as a lazy passenger, it's fucking useless. The whole idea behind this is to glean as much information from all of this as possible. All right. So they're running 88% bonds, 12% call options. Again, this is really cool, because what they're highlighting is that you can essentially create a desired levered amount by using very little in buying power and having a lot sitting in a risk-free rate. And then you can compare the output of that to a nominal portfolio, which we're going to do. Because again, my original thought is to trade the covered strangle, but it doesn't have to be. This is also completely ripe for something like ratio diagonals. Completely ripe. And again, if I was trying to aggressively grow a portfolio, I would personally have some of my money in a covered strangle, in a 2x leverage ETF, maybe 3 times, sometimes. Something like that. That would be a portion of the portfolio that I'm interacting with less frequently and following a very basic rules-based approach generally. That would be happening on the side. And that's kind of what I hope to take a look at here with you as we go through this experiment. Now, for aggressively growing, diagonals. Leverage directional exposure is exactly what I would be doing like a madman. So I like this. We review data to determine how accounts increase or decrease over the period. We run each index alone. Okay. Initial consideration to rebalancing. Rebalancing is super important. So the way that they choose to do this is going to drastically impact the output of the study. We decided to use 6-month call options. That's cool. And sell options 20 or more days before maturity to avoid time. Oh, I see. These options sell. Wait. I'm fucking confused. They're not selling. I'm reading this as they're going to sell these at least 20 days or more. That's how I read this, but I don't understand this fucking sentence. See, this is why. Because I know, this is why the undergrad stuff, I already know what to expect from it, because you know that those professors and stuff that are overseeing the research, like they're going to look at it, but like they're not going to fucking tear it apart. So these options sell approximately 20 or more days before maturity to avoid time decay. Yeah, I'm assuming they mean sell these options. By employing the strategy, it does not need to address or deal with potential tax implications that would apply at the 1-year mark. So they're talking short-term versus long-term capital gains. That means the study does not consider the difference between short-term capital. Yeah, okay. Study considers option at a 50 delta. That's okay. And then they look at 70 delta. That's okay. Yep. All right. J-Ray says, I do wide credit spreads on these, especially when they might be a little bit overbought. Yeah, that could work. Definitely not my go-to, but if it works for you, that's all that matters. Volatility will impact the expected returns of leverage ETFs by reducing them over time. This makes sense. Does the return path of a daily leveraged ETF make sense to you? Because that's going to be one of the most important elements in understanding the performance of these things, is that remembering that they're daily leveraged. Them being daily leveraged reduces their overall profitability. The reason that it reduces their overall profitability is 2 reasons, but it really comes down to this. Let's take a look at QQQ. This gap, guess what TQQQs doesn't get to experience is much of that gap. So if you go to TQQQs and you look at this, the gap on a likened basis is muted than it should be because it's daily leverage. It's not constant leverage. Very important. So one of the things that we might consider as we go through this, again, depending on, this is an open exercise. So if we get to the end of this and we start looking at some of the drawbacks of leverage ETFs, we can also explore alternatives, which we should do anyways. Like a great alternative strategy here would be running something like the covered strangle in a futures product and still trading options on futures around it. But you get rid of a massive issue with these levered ETFs, a massive issue. Now, the drawback is that if we use something like the E-minis, the NASDAQ, whatever it is, we can create the leverage that we want for the amount of money. That's entirely doable. But what we are not able to do is sell puts and take assignment. It's just not a choice. So we can essentially pretend that they're naked short puts and just work on rolling them, but that will also have some drawbacks. The other thing to keep in mind that's a benefit to using something like a covered strangle in a futures-based product is Section 1256 of the tax code. You're not going to get Section 1256 from any of this stuff. So that doesn't really, that is, depending on how much you make, an important factor. So it's just it's something we'll take a look at, because the vision that I have for this allocation is to be something that is lower touch, more rules based, and that can serve as a core allocation of a portfolio while pacing, ideally, slightly outperforming the S&P 500. That's the ultimate objective here. JRE Trade says, can't cash secure futures. Yeah, there's no, because you can't take assignment. So yeah, you get assigned the futures, but it's still unlimited risk. Technically, it's not unlimited risk, but yeah, the things can go to zero. So that's, it's pedantic, but I make the point because it's different than unlimited risk. We colloquially refer to it as unlimited risk. So if you're not a seasoned options trader, you're probably not reading in between the lines thinking, oh yeah, well, it's not actually unlimited. It's just zero, which is a lot of it, but it's not unlimited, right? There is a difference. So yes, futures can go to zero. What I try to remind people when it comes to the concept of unlimited risk is that it is as scary as it sounds. If you have the E-mini futures go to zero, what I remind you is you probably don't care about money anymore. And what I mean is the fucking apocalypse is on. So go get your full warlord on and yeah. Go start shaking gold coins out of weak people's pockets, because that's going to be the game at that point if fucking SPOs are at zero. All right, back through this study. Let's see what they found. This is terribly annoying that this couldn't be on the same page. My OCD literally hates that. Hates that a lot for us. But let's see. Yeah. So about 10% more standard deviation in Qs. That's a little interesting to me. Minimum is much better. Yeah, so this obviously will reduce a lot of the risk. Cool. This is looking at 60-40 with the barbell. Oh, here's 60-40. Okay. I mean, this looks pretty good. Got to be honest with you. Just not doing shit. Okay. So whoever did this, they did okay. Who is this? Eliza Wampler. Nice job. Overall, decent. I give it a B. All right. This one is important. This is from my friend, Michael Gayed. I've had him on the podcast before. There are a lot of issues with this paper. I'm not going to get into that. I simply want to highlight a few things from this paper. So this looks at different leverage returns. This is using manufactured leverage, meaning it's theoretical leverage, to give us some ideas on what return profile looks like for different periods of time, so that we can figure out what we would consider to be optimal return path. This talks about this concept I beat to death on path dependency. The reason why depends on the path so much is because depending on the path will wildly change the outcome of the system. And the reason for that is because if it goes through a favorable path, it will actually start to amplify return profiles. If it goes through an unfavorable path, it'll actually start to amplify negative return profiles. Again, we're just getting beta by trading leveraged ETFs. There's no magic in them. The way that they outperform the S&P 500, quite literally, is by taking more risk. That's it. That's how they make money. There's nothing special about them. There's no inherent edge. There's zero edge in a levered ETF. It's just taking risk. So the reason why this matters is because, again, read between the lines. If I know that path dependency is a big deal, I'm going to think about ways to mitigate path impact. there are different ways to mitigate path impact. Some of them that spring to mind are going to be some sort of momentum following approach, which we'll have to, again, explore. So let's go through. This is talking about, yeah, nuts. Okay. So if you look at, this is a Monte Carlo simulation over 252 days. It shows the growth of 10 grand and using 10% vol. So as volatility starts to change, we can see that volatility has a significant impact on the return profile. So the reason why that matters to us is because depending on the volatility regime we might find ourselves in, we probably would want to change what we're doing a little bit. That's essentially what this tells us. This is talking about using something as simple as 200-day moving averages to avoid this here. So this is showing annualized volatility above and below moving averages. It's showing how high the volatility is when it's below these various moving averages. So if S&P 500 is below the 200-day moving average, its annual volatility is fucking massive, which we know leveraged ETFs do not like. If it's above the 200-day, volatility is much better. So this is something that I would seek to validate in my own data set. Again, I wouldn't take the word for it, but this is something that if I were to test this, I would literally pop into my little sheet and I would say, I want to validate annual volatility based on MAs. We can do like a 10, 20, 50, 150, 180 maybe. Just out of curiosity, 200. It's not that much added work. So I know that I want to see that. The other thing I know is a general assumption here is need to reduce downside path, consider MA rotation strategy, consider RSI / other oscillator. That's another really big risk that we run here is the drawdown risk. We're going to need to solve for that. The other thing I know that we're going to need to solve for is need to resolve scaling protocols and return path, test X period, future returns based on price levels. So what this means is we're using something like a leveraged ETF approach. Again, scaling can't be random. It can't be, oh, we're near highs, I want to put less in. Because the reason why that inherently doesn't make sense is if we take a look at periods near highs. So if we go back here, periods near highs lead to more highs more often than not. So if we start getting really skittish, like here is a term high. If we're really skittish here, then we miss this. Now, if we come in way too heavy here, we get murdered if we hold it all the way down here. So there has to be a balance achieved here. And that's another that's a really common misconception about trend following is if you get too skittish near highs and you don't use enough money, you literally decrease your total profitability, which it cannot be accepted. So it has to be accounted for because, again, most periods when we see highs will be preceded by more highs until there's some sort of change in paradigm. Tommy says, what about scaling down in a continual downturn? It's a great hypothesis. So that's one of the things we can test. So when we get to this point, what I'm doing now is I'm just taking notes on what I need to analyze to make a plan. The other thing I know I need to analyze is determine preferred leverage for cash. That's another thing we're going to have to sort out, because that's going to determine if, depending on, again, when we run a couple different tests here, we're going to have to test SSO, UPRO, QLD to TQs and see which of those in what combinations we prefer the most. The other thing we're going to have to determine is, do we want a bond allocation? I already know the answer to this is Eric doesn't, because they are boring. This is the wrong answer if you're trying to like grow your money smartly, conservatively, but they are boring. So no, for me, dog. Now, again, full transparency. In my Roth IRA, I trade a covered strangle in a leveraged ETF, and it does absolutely have a bond component. But the thing is the way that I trade my Roth IRA is very hands-off. I place maybe 50 trades a year. So it's like going in there once I remember, once in a while, when expiration's coming up, see what transpired, and then that's it. So it's a much more hands-off approach than this, which this, to be clear, is also going to be a generally hands-off approach, but it's just not going to be like, at least super hands-off, in my opinion. This can get, is this merged? I hate when I do that. Don't merge anything. Don't do that. Bingo. Can you analyze aggro or mid approach? Yeah. Tommy, approach to what? Are you talking about an approach to scale the capital? Or we would have to define what the approach is for, then yeah, definitely. I'm more than happy to. Okay, so we have a couple questions. We have a few RFIs that we're going to have to sort out. We don't know if this is going to be SSO yet, so that'll sit there. And then we know that we need to avoid volatility. Okay, so then the other thing we can do is integrating ADR into scaling rules / exposure. So the thesis there could be, if vol is high, scale down. This looks at recessions. So this is just saying if there's a recession where we typically drop below the 200, and if it's expansionary, it's typically above the 200. I don't think there's any shock there. Excess return above and below. So we can see if we use a faster MA, we get a much better net return. Right? That's very clear here. So if you take this 15.7, you take the 2.5, that still beats essentially all of these. But if we use a 10-day, there's a lot of transactions. So again, there's going to be a trade-off here, depending on how active we want to be. Worst 1% of trading days and where they are relative to the MAs, no shock. This matters. Consecutive positive streaks. More of them are going to be above the 200-day, no doubt. Unleveraged buy and hold compared to leverage. This is unleveraged buy and hold compared unleveraged MA. So one of the things that you'll find typically with unlevered buy and hold compared to levered or unlevered MA, the interesting part here is a lot of the times you'll view this, it actually shows time in market beats timing the market. So I'm actually a little surprised to see the 10, the 20, the 100, and the 200-day perform as good as this. It has to do with this being such a long path. So he's using a massive data set. The problem with using and making a decision based on this massive data set is like, this is longer than I'm going to be a fucking live, right? So I don't have 100 years for this thing to shake out. So what I do instead is I start with a really big holding period like this in the test to understand. But then what I do is I scale it into, I segment it. And then I say, okay, well, let's break this 100-year period into 5 20-year periods. And let's just see how things fall in those periods. And I break it into these smaller segments to give me better ideas. And then I personally would break it into 250s, 5 10s, 10 10s, that approach, segmenting it down that way so that I can get really, really specific with the return path. Okay, so this is unlevered buy and hold versus levered buy and hold. Levered buy and hold is shown to beat. We already know this. This is using the rotation. So we can see 2 times performs well, 3 times performs much better, but take a look at the drawdown here. Even with this, and this is what I'm talking about. This goes back for JRA trades. This is what I'm talking about. If the fund existed during this period, it doesn't anymore. This is, again, theoretical leverage. The fund didn't exist during this period, but if it did, it would have gone insolvent because of this. Even the 2 times leveraged went down 98.8. This just goes back to that point I made before. The worst time is ahead of us. We literally cannot make the decision of it's been around for a while. I'm cool with that. That is exceedingly naive. We have to be way more perceptive than that, because literally your livelihood depends on it. Your money depends on it. And I'm literally showing you within the last 100 years, whether we used a 2 times or 3 times leverage ETF, it probably would have blown up. So that tells us we have to do something about how we choose to manage this risk. That's unequivocally got to happen. All right, so let's see. 3 times with the leverage obviously performed the best, then 2 times, then 1 1/4, and then S&P flat. Don't care about that. This is what I care about. Maximum drawdowns. So 2 times goes to 35, 25, 17. What I'm doing right now is I'm comparing the differentials. So like, for example, the 3 times leveraged is actually saved a lot more compared to the 2 times on a relative basis, compared to what it shows you to the upside, which is kind of important to track. About 10 points variance on almost all of these. This says essentially when you get back to highs, here you go, risk of ruin. This talks about essentially the funds blowing up. Well, really your money blowing up, I should say. So this talks about using a leveraged ETF versus leveraged ETF with a rotation versus non. Cool. So that's the next study. I'm going to stop with the studies. I'm actually going to hop off in a minute because I have the GME live stream in about an hour. So I'll recap what we've did so far and then what next steps are going to be. So what we've done so far is understand a little more of the nuance behind how leveraged ETFs perform. We started scoping trading a covered strangle in some sort of leveraged ETFs, and we started outlining some of the future studies that we're going to have to do. There are way more studies than this. Again, like I'm showing you, this is even a pared down process of what I would do, to be completely honest. This is something I'm trying to make it that I think it's a balance between rigorous enough and giving enough information without being overkill. Most of what I do falls deep into overkill. But the other thing that we're going to have to do is we're going to need to download market data for SPY, QQQ, SSO, UPRO, QLD, TQQQs, and for analysis, which I'm going to grab all that. You don't have to worry about that. Obviously, I'll get that through bar chart, and we will be like, the next step again is just going to be a lot of data monkeying this stuff. But this is what it is, right? Like that, an hour just went by and I was generally focused on what we were doing. So the process of building this stuff isn't instant, and it's why there's edge in it. Because what we just went through, again, I think is very basic. And if you ask most traders before they start trading something, how many of them would even do something like this so far, is probably not very many. So I always bring those points to the front just to remind you that when you hear about these massive failure rates of traders, don't worry that much about it, because most of the traders that are trying to do this shit are super undisciplined. They're lazy as fuck. So it's like, yeah, no shit that they don't make money, because they're not putting in any effort to do it. So Tommy says, would approach change if I need money in 10 years or 15 years or 20 years? Of course, massively. Because let's say that I wanted to test the scenario that I need the money in those different periods. I would do like a disaster timing. And what that means is I would give this scenario going back as far as I can with something like Qs. And I would essentially measure like the worst drawdown, how long it took to get back based on two things. First, worst case scenario, you top ticket and then you just hold. That's the worst case scenario. I would compare what that does to the money that I need. And then I would compare based on historic reference, how long it took to recover. So for example, you have a great example of if you happen to top tick Qs here, you're still 11 points off from getting back to all-time highs. Like you are a hot fucking minute away. So that being said, that's the worst case scenario. Then I would have what I call a path case. And path is trading the system as designed. So whatever the system ultimately fleshes out to be, whether it's a combination of moving average crossovers, moving average slopes, and RSI, that's super common for me. That's probably what this will lean towards, just based on how I tend to configure this stuff. Based on all of those things, I would track what my actual maximum drawdown is, and then how long it would take me to get back. Right? So like, let's say, for example, we did something super simple, like a 50-day moving average. You top ticket here, then that 50-day moving average gets you out here, right? So you take a loss, you take a $15 loss, you go from 85 to 70. Then again, in this proverbial case, you stay out of it until you get back in somewhere around here at 70, but then you get stopped right back out at 70 3/4. So that's about a scratch. You might get back in here, you might not. Again, just following the rest of the scenario. So now we're down about $15, rolls all the way down, comes in here. It starts to cross above here. So maybe you enter here at 67. Maybe you get back out at 66.77. So another $16 loss. And then let's say you get back in here at 70. Now you're up $4. So now you're down what? $12 total in this super quick eyeball scenario. So you can run that kind of thing and see what you think. That's what I would do. And I would see what time frames, the worst time frame that's been experienced, use that as a reference, extend it out a little bit. And then I would assess whether or not the period makes sense, right? So then you could get to that and say like, okay, it's going to take me more than 10 years. But then you can add the elements of if it does this, that, and the other thing, I start dollar cost averaging in. That's a different scenario that you would have to test based on the path scenario. But yes, the short answer, Tommy, is the approach would change. I assume so. I don't know the answer out of the gate, but I do know it would change. Alex says, just want to ask, what do I have to study in uni to know this stuff? I'm actually the last guy to ask that because I spend exactly 0 time in school learning about markets. I took a couple markets courses in school and they were so dated that I learned very little. What I can tell you is for both my undergrad and grad degree, I spent a lot of time in stats courses. Those are very helpful. So that would be the route that I think makes a lot of sense, is just understanding how to analyze stuff statistically, and then specializing in something like markets is just stuff I've done on my own. I don't know if there's good programs out there now. I have to assume there are, but I'm unfamiliar with them. So I wish I could give you better advice. But the thing I can tell you is hard skills, right? Like I wouldn't go into finance. And the reason for that is my buddy majored in finance and he doesn't trade at all. I trade. And like the stuff he learned in finance might help a little bit, but that's not the stuff that we're doing, at least in a trading sense. I would focus way more on data analysis than anything. So yeah. All right, gang. So that's part 1 of however many parts this thing is going to be. I might have to retitle it to like core allocation strategy or some shit like that. I have absolutely no idea. Yeah, what it'll be, but it'll be. Mark says this live stream should not be free. I've been trading this strategy for the past year, and I think this is the best approach to trading, but I never went through those academic paper studies. And we are in the infancy, my friend. What would go into this, again, like if we end up going through with the covered strangle approach, depending on what it is, versus diagonals or whatever, there's a lot of homework to be done. But this is the basis for stuff. So we will get there. All right, gang, if you need anything, let me know. Be an outlier. I'll see y'all later.